Let's talk to Connor Campbell. He's the financial analyst at Spreadex. Very good morning to you, young Connor. Right, we've got 3 stocks to go through, companies that are reporting this week. Let's kick off with Kingfisher, the stock mnemonic KGF. In terms of the price movement in 2018, down a measly 0.3%.
Yeah, and it's done all right in the last, I guess it says since December, it's been doing okay. That's I think 2017 wasn't a great year for Kingfisher. Obviously, it's going through its one Kingfisher restructuring plan. I think that's it. You know, at least they intend it to deliver, I think, 500 million extra in profit. I think it's by 2021, 2022. In terms of its figures, it's an incredibly split company in terms of some things are doing phenomenally well and other things are not doing well at all.
Right.
I think both in its half-year figures in September and its third quarter figures in November, you had these split, like, really strong divisions. In the UK and Ireland, I think in third quarter figures in November, UK and Ireland like-for-like sales were at 1.5%, which is fairly decent. However, in there you've got a 1.9% decline for B&Q and a 10.9% rise for Screwfix. So that's sort of where the division lies in the UK. Then internationally, you've got a 4.1% decline in like-for-like sales in France. That's countered by 6% rise in like-for-likes in Poland. Overall, I think total like-for-likes were down 0.5% for the third quarter. That's an improvement on the half year when they were down 2%, and sort of those divisions were a bit more entrenched. However, Kingfisher still managed to, in amongst that sort of fairly difficult to work with set of figures, they managed to post some, especially in the half year, post some decent numbers. I think total sales were up 4.3%. They saw operating pre-tax profit up 0.9% to £440 million, which was far better than expected. They even announced a £60 million share buyback, which is sort of explains why the stock has been on the rise since mid-September, sort of December, sorry, because I think that's when they started to enact that share buyback. In terms of what our clients are doing, however, I think they've been selling around the 340, 345 mark. They just don't fancy the stock at the moment. I think it's not like there's just one issue in Kingfisher. There are so many, for all the good, there is so much bad to go with it. And especially since it's been on a bit of a rise since December, I think they're perhaps looking for its full year figures on Wednesday to disappoint slightly. If it can't match, if it can't post any decent operating pre-tax profit, if it can't beat on those figures, I think it is looking for a pullback, and that's why clients have been selling around the 340, 345
It's
mark.
worth noting in technical analysis that would be called a head and shoulders formation, which is potentially a bearish formation. Okay, let's move on to Ted Baker, the mnemonic TED, up 11% in 2018. Now, I've never been to a Ted Baker store, so I'm fascinated to see your thoughts.
Yeah, it's one of those, I think part of the reason is because they don't have too many stores, and that is why one of the reasons why they're doing quite well at the moment compared to its sort of ostensible peers like Next and M&S. It hasn't got that as much bricks and mortar exposure. That combined with, I think it was its third quarter figures in January, or its post-Christmas figures in January, you can see sort of where it gapped there. That's where the brunt of its growth has come from in 2018. I think it said total retail sales were up 9%, which,
wow,
in that kind of sector is amazing.
Yep.
I think e-commerce sales were up 30.5%. They now account for 31% of the total retail sales.
So online.
Yeah, very strong. It seems to have pivoted towards online in a better, more efficient and sort of speedier way than some of its peers. Again, explaining why it's posting 9% total retail sales growth. In terms of its full year figures, I think it's on Thursday, analysts are expecting a 12% rise in pre-tax profit to 74 million. That's very strong. Again, like that's strong full stop, let alone in a retail sector that, that January update came amidst a very gloomy set of figures, sort of retail sector wide in the UK. So Ted Baker does seem to be ahead of the curve in this regard. I think the final dividends expected to be up 10%. I think obviously investors are also going to want an update on current trading, what it's going to expect for its sort of financial 2018. But its figures are very strong. Our clients are buying around the £30 mark. I think it seems to be doing very well at the moment.
And is this a younger generation shop?
I think it's more a high-end shop. I think that's one of the things that I guess, I think Ted Baker itself pointed out that it gets lumped in with Next and M&S, but they're not quite the same thing. I think Ted Baker is a slightly more upmarket brand, not necessarily Burberry levels, but somewhere between Burberry and Next and M&S, and I think that's perhaps again where it's, whilst Next and M&S have their customers sort of their customer base eaten into by Primark, Ted Baker is a bit above that, and I think it can withstand, I guess, the onslaught from slightly cheaper brands like Primark and ASOS and Boohoo and things like that.
Understood. Client-wise?
Client-wise, yeah, like I said, buying around the £30 mark. I think they're supporting the stock at the
And
moment.
at £30, people are happy to buy that.
Yeah, it's
Wow.
interesting, but I think just because those figures were so strong back in January, and they 12% rise in pre-tax profit, 10% rise in final dividend, those kinds of eye-catching headline figures, I think, are why it's getting the support with £30.
Okay, let's wrap up with next. Obviously, Coats NXT up just under 5% in 2018. A fascinating tale of this in terms of going online, the catalogue.
Yeah, it's
and the old adage, never short next shares.
Yeah, you can see sort of two fairly sizable gaps on the chart. But it was gapping all over the place in 2017. Basically, every single time it released some kind of update, because Next and Lord Wolfson are very keen to sort of manage investor expectation. Every update, I guess it's most worth paying attention to what they're suggesting for the rest of the year, because they tend to be quite conservative in their estimates. For example, I think it's expecting full year total retail sales to be up 0.3%. That's a shift. That announcement in January was a shift from them expecting a 0.3% decline. I think pre-tax profits are expected to be down 8.3% to 725 million, which isn't good, but it's better than the 9.3% decline forecast. Again, earnings per share expected to be down 5.7%. Again, better than the 6.8% they'd forecast. They're very keen to sort of keep investor expectations low. So then in January you get this sort of these big moves higher, because then its figures are significantly better than they had been promised. In terms of its sort of performance, again, it's really split between retail and online. I think in January, it's sort of post-Christmas, fourth quarter sales. I think retail were down 6.1%, but online they were up like 13.6%. I think that led total sales to 1.5, being up 1.5%, which again isn't bad for a high street, a high street staple. Its online offerings, whilst not clearly as strong as Ted Baker, are still significant, and compared to something like M&S, they're light years apart in terms of their online offerings. In terms of what our clients are doing, they're buying around the £47, £48 mark. The only difficulty is with Next, at the moment, it's sort of between its lows and highs. It's well off the £53 mark, but way above the £42 mark, which makes it a bit difficult heading into the full year figures on Friday, because it sort of could go either way. I think it's going to be dependent maybe on its forecast for 2019, its sort of financial 2019. I think at the moment they stand at a sort of 1% increase in total full year sales, full price sales, a 1.1% rise in earnings per share, and a 2.8% decline in pre-tax profit to £705 million. If there's any movement in those three forecasts for the upcoming year, I think that's where the reaction is going to lie on Friday morning.
Finally, £47 is an absolute key chart point, because this is basically the bottom and top of the gap. So on that note, Connor, thank you very much indeed.